energy supply cut holds significant implications, as it has the potential to reshape the global energy market and influence US-Canada relations. In this context, Canada is focused on safeguarding its citizens during this crucial transition. This shift in energy sourcing from the US to Canada by European countries originates from the energy crisis prompted by the Russia-Ukraine war, which has led to strategic alterations in global supply chains. Simultaneously, US natural gas prices have soared, rendering American LNG less competitive for European buyers. As a result, many are now exploring alternatives, including Canadian energy resources. Historically, the US has utilized energy exports as a tool for geopolitical influence. However, inconsistencies in its energy policy have introduced uncertainty for Europe. This situation has encouraged European nations to pursue more stable partnerships. Canada's extensive natural resources feature some of the largest reserves of oil, gas, and critical minerals in the world. This abundance of resources significantly enhances its attractiveness to European markets. Moreover, Canada's investment in clean energy sources, such as wind, solar, and hydroelectric power, aligns well with Europe's sustainability objectives, further solidifying Canada as a desirable long-term energy partner. As the EU emphasizes green energy, the need for reliable material sources increases. Consequently, Canada becomes an essential partner in the transition to a greener future, which directly influences the US energy market. With Europe potentially looking to Canada for energy, US energy companies face the risk of losing billions as they might forfeit their largest LNG export market. This scenario would considerably affect their revenue streams. Traditionally, the US has leveraged energy exports for foreign policy advantages, but Canada's rising prominence could challenge this strategy. Such a shift presents significant obstacles for US diplomacy and negotiations. In response, Canada's retaliatory tariffs could result in a $30 billion impact on US goods, highlighting the potential for escalating trade conflicts as part of a broader economic strategy. Furthermore, by directing energy exports toward Asia, particularly China, Canada seeks to secure new markets, a move that could fundamentally reshape North American energy dynamics and boost its economic resilience. The heavy reliance of the US on Canadian crude oil raises concerns about potential energy shortages should exports decline. This dependency poses significant risks to the US economy and could affect gas prices substantially. As these dynamics unfold, questions arise about whether Canada will prioritize sustainability in its energy policies or compromise its climate goals for economic benefits. This decision will undoubtedly influence global energy dynamics. The potential intensification of the energy trade conflict between the US and Canada carries serious economic implications for both nations, posing risks to the stability of the North American energy market. Should Canada decide to cut off energy exports to the US, a sudden spike in fuel prices could ensue, impacting consumers and businesses alike. The ripple effects would reverberate across all sectors of the economy. In particular, the Midwest's dependence on Canadian heavy crude makes it susceptible to job losses and economic strain if tariffs come into play, significantly affecting local refineries. Rising energy costs pose challenges to industrial production, especially in manufacturing and agriculture, resulting in US goods becoming less competitive in the global marketplace. Ultimately, the US risks forfeiting its position as a global energy leader as Europe shifts its focus to Canada for energy resources, escalating the stakes in this economic dispute.